Hey, so the headlines are saying that we just had the worst crash since COVID, with Nasdaq just hit its 2026 low, while the Dow is chilling near all-time highs. Same day, same market. But what if I tell you that it's not a crash, it's a message, and most people are reading it completely wrong? Look, if you're short on time or you just don't feel like listening to some random cat guy ramble for 10 minutes, here's your one takeaway. February 4th wasn't about bad earnings. It was about the market deciding that the future of software and AI stocks is worth less than yesterday. Not because the business is broke, but because the story changed. Earnings are the present. Price is about an uncertain future. And honestly, if you're sitting there staring at your portfolio feeling sick right now, take a breath. This is not 2008. This is not systemic collapse. The Dow was near record highs the same day the Nasdaq tanked. That alone should tell you the financial system isn't breaking. What happened was painful, sure, especially if you were concentrated in tech and software, but painful and catastrophic are two very different things. The companies you own, most of them are still making money, still have customers, still functioning. The market just had a mood swing about what it's willing to pay for future growth. So no, you don't need to panic sell into the red. You don't need to liquidate everything and hide in a bunker with canned tuna. This is rotation and repricing, not Armageddon. But if you stick around, I'll show you exactly why this happened, how the plumbing of the market amplified the move, and what it actually means going forward. No fluff, just data, and hopefully by the end you'll feel a lot more informed than anxious. And for those who are new here, hey, I'm DataCat, former corporate slave, and I mean that literally. I spent years as an analyst inside a Fortune 50 company, staring at messy data and models which don't work. You know the drill. About 6 months ago, I traded the corporate grind for lasers and keyboards. Started this channel because I figured if I'm going to lose sleep over markets anyway, might as well share what I'm seeing. Quick disclaimer, I'm not here to sell you a course. I'm not going to tell you I've got some secret sauce that'll make you rich. I'm just a guy, well, a cat, who reads a lot of filings and has opinions. Take everything with a grain of salt, but your like and subscribe would be much appreciated. Alright, let's get into it. So Wednesday, markets are red, headlines are screaming, your portfolio looks like someone knocked your coffee off the desk. But here's something most people missed. The Dow was basically fine, near record highs. The S&P suffered a pullback, but recovered most in the afternoon. Meanwhile, the Nasdaq sliding to its 2026 low. Now if this were a real systemic crash, like the financial system is breaking kind of crash, everything goes down together, correlations spike to 1, you don't get to hide anywhere. So I'm going to draw a line here. That's not what happened. What we saw was leadership crashing, not the market crashing. The stocks that everyone owned, the darlings, the crowded trades, those got hammered. Everything else, held up okay. Value stocks, defensives, smaller names, they rotated into those. This is what I call a painful if you own what everyone owns tape. It's not everything is broken, it's the popular kids just got detention. And by the way, I actually made a video a few weeks back about crowded trades. What they are, why they're dangerous, how to spot them. If you haven't seen it, I'll link it somewhere around here. Understanding crowded positioning is kind of essential for making sense of days like February 4th. Okay, so here's where people get confused. They look at earnings reports and go, wait, these companies are making money. Why is the stock down like 10-20%? Here's the thing, and this is important, so let me slow down a bit. A lot of these AI and software stocks, they're priced as long duration assets, meaning a huge chunk of their valuation sits way out in the future, like years and years from now. The market is essentially saying, I believe this company will be a cash machine in 2035, so I'll pay a premium today. But what happens when that belief gets shaken? On February 4th, the narrative shifted. There was chatter about AI tools commoditizing what software companies sell. Anthropic got mentioned. Suddenly, the moat doesn't look as wide. The pricing power doesn't look as strong. The terminal growth rate maybe not as juicy. And here's the mechanism. This doesn't have to hit this quarter's earnings at all. It attacks the multiple. The market goes, oh, your business model might have a shorter shelf life than I thought. And boom, stock price adjusts violently, so earnings were healthy and the stock still dumped. Both things can be true at the same time. Think of it this way. It's like if someone told you your 9 lives might actually be 6. Nothing changed today, but your whole outlook just got worse. Now this wasn't just 1 or 2 names, this was broad. Let me give you some real data. The iShares Expanded Tech Software ETF, ticker IGV, was down about 3% on February 4th. and it was on pace for its 7th straight day of losses. 7 days. CNBC also reported multiple IGV constituents hitting fresh 52-week lows. We're talking Salesforce, ServiceNow, HubSpot, Atlassian, and these aren't small companies. When you see a multi-day losing streak plus a bunch of new lows across a whole sector ETF, that's not one company missed earnings. That's multiple compression. That's the market repricing the entire regime for software. It's like the market just suddenly collectively decided, yeah, we were paying too much for this whole category. And once that decision gets made, individual company fundamentals kind of don't matter as much in the short term. Okay, so we've established the why, but a lot of people are also asking, why was the move so violent? If it's just a story change, why did it feel like a crash? Great question. And this is where it gets a bit technical, so bear with me. When you have crowded positions, everyone owns the same stuff, and those positions start slipping, a chain reaction kicks off. First, the longs start selling, then put demand rises because people want to hedge. Implied volatility spikes. Now, market makers who sold those puts, they have to hedge too. And depending on their positioning, they might be what's called short gamma, which means as the market falls, they have to sell more to stay hedged. It's a feedback loop. Then you've got systematic strategies, volatility control funds, trend followers, risk parity. And when realized volatility spikes, they mechanically de-risk. They sell. Not because they think earnings are bad, just because their models told them to. By the time regular investors finish reading the earnings report and go, wait, this looks fine, the flow wave already pushed prices through support levels. Let me hit you with some actual data here. On February 4th, the short sale volume ratio for QQQ jumped to about 60%. Day before, around 42%. That's a big spike. Options activity was insane. The $600 puts, almost 40,000 contracts. The 605 puts, another 39,000. And these were 1 day to expiration options. Traders were scrambling for protection, and dealers were scrambling to hedge. Open interest movements showed massive repositioning too. The 620 calls saw open interest jump by over 8,000 contracts in a single day. Some put strikes saw open interest balloon by over 10 times. All of this is the fingerprint of flow-driven selling. The tape moved because positioning and hedging mechanics forced it to, not just because of fundamentals. And a quick note on the macro side, the ADP jobs report came out showing 22,000 private jobs added in January. That's weak. Really weak. Now, if you've been around for a while, you'd know normally weak jobs data can actually be bullish for growth stocks because it means the Fed might cut rates. Lower rates, higher present value of future cash flows, stocks go up. Simple enough. But that logic has to assume the market is in rate cut hopium mode. On February 4th, the market was in uncertainty discount mode. The distribution of outcomes widened, and when uncertainty goes up, investors stop paying premium prices for expensive duration assets. Value and defensives outperformed. Growth got hit, even though, again, earnings were quote-unquote fine. And let me give you one more data point, which I don't usually talk about because I'll admit I know very little about it compared with the others, but Bitcoin dropped below 76,000 on the same day. Why does that matter? Because in recent years, crypto acts like a high-frequency risk appetite indicator, even for folks like me who don't really invest in crypto. But when Bitcoin is weak alongside tech and software, it's telling you this is a degrossing event, a high beta unwind, not a single stock story. Think of it like when all the cats in the neighborhood start acting weird at the same time. Something's up. Pay attention. So, from what I've gathered, maybe I'm wrong, but I'd say February 4th was not a classic stock market crash. It was a violent rotation and derating of long-duration AI and software names, amplified by hedging flows and systematic selling, with cross-asset risk appetite cooling off. The market didn't decide earnings were bad. The market just suddenly decided the future for a crowded pocket of tech and software is worth less. Less moat, less duration, more uncertainty. And the positioning machinery? It turned that decision into a brutal tape. If you were concentrated in those names, yeah, it felt like a crash. If you were diversified into value, defensives, or just not in the crowded trades, it was a choppy day, but not the end of the world. Okay, that's the breakdown. If this helped you understand what actually happened, and more importantly, why, go ahead and hit that like button. It helps the channel more than you'd think, and if you're not subscribed yet, consider it. I put out videos like this regularly, trying to cut through the noise and give you actual analysis, not just headlines. No courses, no Discord pumps, just a former corporate cat trying to be useful. Stay curious, and don't chase the crowded trades. You saw what happens. DataCat out, and I'll see you in the next one.